There is a lot of talk about the possibility of an interest rate cut. Everyone is excited. People can't wait to get cheap money so that they can finally get their hands on that home at a much more affordable price. But is that the only goal you should aim for? Who knows? So I came across this article that I found quite interesting, and I think you'll find a lot of value in it as well. Let's get into it. If you're new here, welcome to No Rise. I created this channel to share my journey in real estate investing, as well as my journey investing in the stock market, precious metals, and small businesses. Hope you enjoy it. So here it is, courtesy of CNBC. 5 top money moves to consider before the Federal Reserve first rate cut. Now, according to this, the key points that we should focus on is the fact that the Federal Reserve Chair signaled recently that lower interests are coming soon. Now, just to make it clear, nobody has a crystal ball. The fact that Jerome Powell is saying that there is a possibility that the rates might be cut, we still don't know if that's truly what's going to happen. Because from the moment he announced it to that Fed meeting that's about to take place in September, a lot of things can happen in between. So all we have left is to hope that the rates are going to come down, but we don't truly know that that's in fact what's going to happen. However, it's always good to be prepared. And that's why we're analyzing this article. So in anticipation to that rate cut, everything from car loans and mortgages to credit cards will be impacted once the Fed starts trimming its benchmark. And here's that famous phrase everyone keeps talking about. The time has come for policy to adjust, the central bank leader said at the Fed's annual retreat in Jackson Hole, Wyoming. For Americans struggling to keep up with sky-high interest rates, a likely quarter-point cut in September may bring some welcome relief, meaning 0.25%, especially with the right preparation. Now, some are anticipating a more aggressive half-point move, meaning 0.5%, but the chances of that happening is roughly 1 in 3. You got more chances to see a quarter-point cut than a half a point. So if you are a consumer, now is the time to say, what does my spending look like? And where will my money grow the most? And what options do I have? Because currently, the federal funds rate is at the highest level in 2 decades in a range of 5.25% to 5.50%. From a customer perspective, it is important to know that lower interest rates will be a gradual process. The trip down is likely to be much lower than the series of interest rate hikes, in which quickly pushed the rates higher by 5.25% points in 2022 and 2023. So in simple terms, if you're anticipating a rate cut, just set your expectation that it's going to happen very, very slowly, gradually. You're not going to see a steep drop in rates because I think that what they're trying to do is to have inflation under control. They don't want inflation to get out of hand like it did recently. And in anticipation to those rate cuts, here are 5 tips that CNBC shares. Number 1, strategize paying down credit card debt. With a rate cut, the prime rate lowers too, and the interest rates on variable rate debt, most notably credit cards, are likely to follow, reducing your monthly payments. So according to this example, the average interest rates on a new credit card today is nearly 25%, according to LendingTree data. And at that rate, if you pay $250 per month on a car with a $5,000 balance, it will cost you more than $1,500 in interest and take 27 months to pay off. If the central bank cut rates by a quarter point, you will save $21 altogether and be able to pay off the balance 1 month faster. Now, I know $21 doesn't seem like it's too much, but if you take $21 and multiply that by 27 months, we're talking about $567 that you could get back in your pocket if the rates do go down. I don't know about you, but I can use an extra $567. But if that's not an option for you, according to this article, you can try doing a balance transfer. You can transfer the balance from the credit card with the highest interest rates to one that offers a 0% rate. Now, the second tip, lock in a high yield savings rate. Since rates on online savings accounts, money market accounts, and certificate of deposit, meaning CDs, are all poised to go down, experts say that this is the time to lock in some of the highest return in decades. For now, top yielding online savings accounts are paying more than 5%, well above the rate of inflation. Although those rates will fall once the central bank lowers its benchmark, a typical saver with about $8,000 in a checking or savings account could earn an additional $200 a year by moving that money into a high yield account that earns an interest rate of 2.5% or more, according to a recent survey by Santander Bank in June. I don't necessarily agree with this point because I view things a little bit different. I prefer to have money working for me. Hence, I like to invest my money. I like to invest it in real estate or the stock market. But if you're the type of person who has no knowledge whatsoever on how to invest in real estate or the stock market, then putting your money in a high yield savings account or a CD with a high yield will be your best option. Because if you don't know what you're doing, you shouldn't be investing your money because that's basically gambling. If you're that type of person, then try to go for the safer route and put your money in a savings account and earn that interest. And on top of that, your money is also protected by the FDIC. But if you happen to know where to invest and you have an asset in particular that you like to invest to, my personal opinion is that you should put that money work for you instead. That's what I would do with my money instead of leaving it there sitting in a bank account. If you're learning a lot with this episode, remember to hit the like button and also share this video with someone who you know will benefit from this content. Now, the third tip, and right from the get-go, I'm going to tell you I disagree with this 100%. So according to this article, this tip suggests that you should consider the right time to finance a big purchase. If you're planning a major purchase, like a home or a car, then it might pay to wait, since lower interest rates could reduce the cost of financing down the road. Timing your purchase to coincide with the lower rates can save you money over the life of the loan. I don't agree with this tip because the way it works with real estate is that not every single house in the market is going to be your dream house or is going to be the right house. Not every single house in the market is going to be at the right price, at the right range, or with the right school district. And if you're an investor, it works exactly the same way. Not every piece of real estate that you see out there is going to generate cash flow with you. So if you're finding the property that meets the right criteria, why would you want to postpone it? Yes, I get it. You probably will want to postpone it so you can get the lower rates. But remember, everything you're saying no to is a yes for someone else. If you let go of that house that took you so long to find, chances are someone else is going to buy it. And let's say no one buys it yet and it's still available for you. With the rates going down, the anticipation is that the property prices will go up again because as far as I know, we're still in the middle of a housing shortage. So as soon as people know that they can get access to cheap money, competition is going to enter the market and with force. So whatever house you saw today at a certain price might be more expensive when they lower the rates. So if you have that opportunity to get your hands on that property, get it now if you're financially ready and then worry about the rates later. If you happen to be an investor, same thing. It is very hard to find properties that can cash flow. So if you're finding a property that is cash flowing right now, even with the high rates that we have today, why would you want to postpone that to later? You want to snatch it right now because chances are that property will not be there by the time you wait for the rates to go down. But again, that's just my opinion. That's how I would do it. What would you do in your case? And just to clarify, because I've seen some comments saying that, of course, you want to push for real estate. Of course, you want people to buy houses because you're an agent. I gain nothing out of pushing you, quote unquote, to buy real estate because I could easily just tell you to not buy anything and just keep the houses for myself. This channel was not created to push an agenda or anything like that. This channel was created for people who are looking for information so that one day they can afford their primary home or why not become real estate investors. But if you're not the type of person who's looking for information to grow and to make things happen, then this is not the right channel for you. Next tip on the list, assess the right time to refinance. And I agree with this 100%. For those struggling with existing debt, there might be more options for refinancing once rate drops. I agree. Private student loans, for example, tend to have a variable rate tied to the prime, treasury bill, or another rate index, which means that once the Fed starts cutting interest rates, the rates on those private student loans will come down as well. And this doesn't apply just to the topic of student loans. It also applies to real estate. In fact, I recently had a conversation with one of our students in our investment program, and this person was actually asking, should I refinance my property now and pull the equity out today, or should I wait for the rates to go down? So I told him that if I was in his shoes, what I would do is to wait for the rates to go down. Because if he does refinance when the rates are lower, he's going to be enjoying a lower monthly payment. But the benefit doesn't end there. If rates do go down, chances are that, once again, there will be more competition entering the market, and that could drive property prices up. Again, I don't have a magic mold to determine what will happen in the future, but that's what everyone is anticipating, right? Supply and demand, there's not enough housing in the market. Therefore, whatever little is left, people are going to compete for it, offering the highest prices possible. If that happens, that means his property price could possibly go up. And that means he's going to be able to pull out even more equity, more money out, and have more opportunities or options when it comes to how he wants to use the additional equity that he gets to pull out. If you want to learn more about the topic of the whole supply and demand and whether housing prices are going to go up or down, here's a video that you can check out after you're done with this one. Next tip, perfect your credit score. Those with better credit will already qualify for lower interest rates. Yes, I agree with the article as well. You should take advantage of the low interest rate so that you can pay off that loan faster, especially if it's bad debt, meaning debt that you have to work really hard to pay it off. And that's usually credit card debt. Get rid of that bad debt. And if you have to go into debt again, do it with good debt, meaning debt that's going to help you buy more asset and make money work for you, like investing in a piece of real estate. That mortgage right there, that's considered good debt if you invest in a piece of real estate that gives you cash flow. Otherwise, it's just bad debt and you should get rid of it by paying it off as fast as you can. If you're still interested in the video that I mentioned earlier, you can check it out right here.